Welcome to the Deep Dive. Today we're tackling, well, a really significant question. It's got major implications for a business titan, Berkshire Hathaway.
Absolutely. We're looking at an article from The Motley Fool, published just recently, May 4th, 2025, and it poses this fascinating question. Could the rise of autonomous vehicles, self-driving cars, actually pose a threat to Berkshire's insurance business?
Exactly, which, as we know, has become this powerhouse of profit for them. So our mission here really is to unpack this. How might these self-driving cars totally reshape insurance? And what could that mean for a company as huge and influential as Berkshire?
It's a massive question, especially when you consider Berkshire's financial standing right now. End of Q1 2025, they were sitting on, $342.39 billion in cash?
Yeah.
Just staggering.
Incredible numbers.
And their public equity portfolio, also huge, $277.41 billion. But, a lot of the value, the real engine, comes from their wholly owned businesses. And within that, property and casualty insurance, P&C, it's critical, a real cornerstone.
Yeah. Right. Which brings us straight to the heart of it, doesn't it? If P&C insurance is that dominant for them now, could this seemingly inevitable shift towards cars driving themselves actually become a major hurdle? Could their prized cash cow be facing a bit of a challenge here?
Well, let's maybe start by emphasizing just how vital insurance has become for them. The Motley Fool article calls it their most prized cash cow. And honestly, the numbers back that up. In just the first 3 months of 2025, think about this. Their combined income from insurance underwriting and investment returns hit $4.23 billion.
Wow. $4.23 billion in one quarter.
Yep. And that's nearly 44%, 43.9% to be precise, of their total operating earnings.
Okay, so almost half their operating profit comes from insurance activities.
Exactly. So you can see why any potential disruption in that sector, like, say, autonomous vehicles, gets a lot of attention.
Yeah, it really paints a clear picture. And it's worth remembering, too, that this isn't accidental. Berkshire has deliberately focused more on P&C, right? They've sort of stepped back from life insurance, partly because of worries about leverage and private equity risks in that area.
Precisely. It's a strategic choice. P&C is where they've doubled down. It's core. Now, thinking about the future with autonomous vehicles, it's always interesting to look at Warren Buffett's perspective. And the article suggests he's actually quite welcoming of change in the auto insurance world.
Really? Welcoming?
Yeah, he's quoted saying, "We expect change in all of our ideas," which is, pretty forward-thinking, wouldn't you say?
It is, especially given, his track record and status. It shows adaptability. And didn't he provide some historical context, too? Something about GEICO costs?
He did. Really insightful. He talked about how back in the 1950s, a GEICO policy might cost, say, $40 a year.
Right.
Whereas today, a similar policy could easily run you $2,000.
A huge jump.
A massive jump. But, and this is the kicker, over that same period, the rate of accidents has actually fallen by over 80%.
80% fewer accidents, but costs way up. That's counterintuitive.
It is. But Buffett's point seems to be, even if autonomous vehicles cut accidents even further, it doesn't automatically kill the insurance business model. The premiums, the value, the whole structure. It just evolves.
Okay, that makes sense. The relationship between risk and cost isn't always linear, I guess.
Exactly. That history shows the industry is constantly adapting. And building on that, you have Ajit Jain, Berkshire's vice chair for insurance. Hugely respected. He offers this really compelling analysis about full autonomy.
And what's his take?
Well, his view is that with full autonomy, the focus of insurance could shift quite dramatically away from, the driver making a mistake and more towards the automaker's errors or omissions, issues with the self-driving tech itself.
Okay, hold on. Let's unpack that. So instead of my policy covering me if I crash, it might be more about covering, say, Ford or Tesla if their autonomous system fails and causes the accident.
Precisely. It becomes much more like a product liability issue.
Wow. That's a fundamental shift. Product liability on a massive scale.
It absolutely is. It changes who bears the risk and who needs the insurance, really. But interestingly, even with this potential upheaval, Buffett seems confident. He's reiterated faith in the auto insurance business and, crucially, in Berkshire having these, quote, unusual advantages.
Advantages that competitors can't easily copy.
That's the implication. Things that are hard to replicate. It signals a real belief they can navigate this transition successfully.
Which must be reassuring for their investors looking at this autonomous future. Now, the article also makes a very practical point, right? We're not flipping a switch to full autonomy overnight.
Definitely not. Widespread, fully autonomous vehicles on all U.S. roads, that's still some ways off.
So it's going to be a gradual process, years, likely. Which makes me wonder, what about the meantime, this interim period? Could it actually become more profitable, at least for a while? With this mix of human drivers and autonomous cars sharing the road, interacting, maybe sometimes clashing.
That's a really sharp question. And yes, the article does touch on that possibility. Think about it. A mixed fleet. Humans driving, AI driving. The interactions could create entirely new kinds of risks, new accident scenarios we haven't even thought of yet.
Right, unforeseen consequences.
Exactly. And that potentially riskier environment, at least in the medium term, might actually make insurance more necessary and therefore potentially more profitable for the insurers who figure it out.
Huh. So paradoxically, the move towards safer cars could temporarily increase certain risks during the transition.
It's possible. We might also see completely new insurance models pop up, like policies specifically for autonomous vehicle owners, or maybe even automakers bundling insurance right with the car sale.
That makes sense. We're already seeing automakers dip their toes in the water, aren't we? The article mentions Tesla's real-time insurance, using safety scores from their full self-driving system for discounts.
Yeah, that's a prime example. It shows how vehicle data, real-time data, could increasingly shape insurance pricing.
It feels like a first step on that road.
It does. But, as the article rightly points out, insuring fully autonomous vehicles, that's a different ballgame altogether. Much more complex challenges than even sophisticated driver assist systems.
Because the liability question gets so much trickier when there's no human clearly in control.
Right, exactly. Who or what is truly responsible when something goes wrong?
So given all this potential disruption, how does Berkshire's famous long-term thinking fit in? We always hear about Buffett focusing on decades, not quarters.
And that philosophy, highlighted in the article, could be a massive advantage here. Buffett's famous line, "We don't do anything based on its impact on quarterly or annual earnings."
Right. Play the long game.
That mindset gives them breathing room. Flexibility. They can absorb short-term bumps, adapt thoughtfully, deliberately. If competitors are maybe more focused on hitting next quarter's numbers,
Berkshire can wait them out or make smarter long-term bets.
potentially, yes.
Yeah.
It could allow them to gain market share as this all shakes out, while others maybe stumble focusing on the short term.
It really shows the power of that long-term vision in navigating big changes. The article also stresses, quite rightly, how important it is to just, watch how this tech actually affects things. How does it change underwriting? How does it impact Berkshire's bottom line from insurance?
Absolutely critical. For investors, for Berkshire itself, they need to constantly monitor the real-world impact. Track the accident rates, the repair costs, how liability claims are actually playing out. That's the only way to truly understand the long-term implications for their insurance business, which, as we've established, is just so vital to their overall success.
Okay, so let's try and pull the main threads together from our deep dive today. It seems clear that autonomous vehicles represent a potentially huge transformation for auto insurance, a sector that's become absolutely central to Berkshire Hathaway's success.
Definitely a major shift on the horizon. But the takeaway seems to be that Berkshire isn't exactly caught flat-footed here. Their financial strength, the strategic thinking of Buffett and Jain, that deep-seated long-term focus, it all suggests they're pretty well positioned to adapt, maybe even unusually well positioned.
Right. This expected shift from driver liability to potentially product liability, plus the emergence of new insurance models, it will certainly reshape the landscape, no doubt about that.
But Berkshire's inherent advantages, their history of navigating big industry shifts, it points towards resilience, doesn't it?
It really does seem that way. They seem built to handle this kind of long-term evolution.
Which leads us to maybe a final thought for you, the listener, to chew on. As cars become more autonomous, think about what other industries rely heavily on, traditional risk assessment, on assumptions about human behavior.
Good question. Where else might autonomy cause similar ripples?
Exactly. What other sectors might face these kinds of profound, maybe disruptive transformations? And perhaps more importantly, which companies out there, maybe ones with that same kind of long-term vision like Berkshire, which ones might be best set up to not just survive, but actually thrive and lead in those changing markets?
Something definitely worth pondering as technology keeps marching forward and reshaping, pretty much everything around us.